into a space where I'm sure many, many startups want to know about this. It's like that golden question, funding your business and secrets to getting your business funded. Every entrepreneur is going to want to know this. For this keynote address, we have with us the Managing Director of Norwest, Mr. Niren Shah. Allow me to introduce him to you. Niren brings to NVP over 20 years of entrepreneurial, operational finance, and investment banking experience, and has helped spearhead Norwest Ventures Partners' $700 million invested in India. Niren is on the board and has helped advise venture capital investments such as Quicker.com, Pepperfry.com, Suvidha, InfoServe, Comly Media, and Swiggy.com. Growth equity investments include Shriram City, Jain Irrigation, IndusInd Bank, Yes Bank, Ratna Bank, and many, many more. Niren was previously in California as a Senior Director of Strategy and Ventures at eBay Inc. So we are very excited to hear Niren speak about this very pertinent topic for us. So please, with that, ladies and gentlemen, join me in welcoming Niren Shah to the stage.
Hey, thanks very much for that kind introduction. It's a real privilege to be here. One of the largest conferences. Big thank you to Ashish. I think I've been here on 2 or 3 occasions, and every year I'm kind of seeing the ecosystem getting more nurtured. It does feel like India is coming a long way, so very happy to be here. And once again, thank you to eTailingIndia. What I'm going to do is, like any good, okay, perfect, thank you. So like any good presentation, keynote, conferences, I sat down at about 11 o'clock last night and said, what am I going to talk about, right? And initially I thought it was a panel, so I said, listen, I'll just come here and moderate a panel, and then realized that it's not a panel. I'm actually speaking alone on stage. So I sat there and I was watching some Star TV, and I was watching this movie called Exodus. It's about Moses and the 10 Commandments. I looked at my topic and it says funding, and then I've been associated with, at KPMG I used to do fundraising for startups in '97 in India. Post that, I was at Bazi.com. I was one of the original guys there. So we went through multiple rounds of funding, and we actually exited to eBay, then moved to eBay, ran their venture group globally and strategy as well. Did tons and tons of both acquisitions as well as investments. And then also had the privilege of joining Norwest in the US. It's a global $6 billion fund. Spent some time in California, came here about 8 years ago to open the office. One very interesting thread through all those 4 things is that I've been involved in a lot of funding discussions. And it's been very, very, I think it's almost been 15 or 18 years where I've been doing this. So I did spend, if you see me a little bit this, I've been up till 3 o'clock really trying to distill some of my thoughts, especially for a lot of entrepreneurs out there on what I can talk about, in terms of, fundraising. So I present to you what I call the 10 commandments of fundraising. And the idea here is that it's a very honest view of fundraising as I've seen it the last 15 years, not really putting my VC hat on. So the first one is very simple. I think Sandeep mentioned, and by the way, Sandeep, I really enjoyed the keynote you just did. It's a lot of commitment, right? Raising funds is a lot of commitment. You'll see it in the other 9 commandments, but there's a lot of commitment here. So I've been an entrepreneur, I've raised funds, I've been on the investor side, I've been on the banker side, you name it. My first question is, if I were to start a company tomorrow morning, my first thought would be, I'm not raising funds. There's just no way. It's like starting, it's like one of you guys, when I was out of shape, fat, and said, hey, I want to run a marathon. Your first answer is, listen, I'm not going to do it. Let me just go have some chocolate pudding instead. So it's really an effort. People don't understand it as well. A lot of people catch me in the hallway saying, listen, I'm thinking of starting. I remember this kid had come across a few years ago, says, I'm in college. I want to, build a few football stadiums. Can you give me $20 million? I said, you're still in college. What's the plan? He said, I don't have much of a plan, but I heard you're a VC. You're giving money, right? I would like 100 crores. So I looked at him, he looked at me, and after a few minutes I said, listen, I think we should have a chat. 100 crores it's possible, but it's not going to come so easily. He said, then why are you a venture capital? I said, look, venture capital, I'm in the business of actually trying to make money without taking any risk. Somebody told me that, listen, put some money down and you will make a 10x and you don't have to take risks. That's my best case. Just completely random stuff. I have to diligence everything. And as the story goes that, even with this guy, I spent a lot of time explaining to him that, listen, there are lots and lots of learnings, right, which everyone goes through when they start funding companies. They have lots of learnings. It's becoming more of a science than an art on whether a company is fundable, whether a management team is fundable, etc. I would still deeply, for all entrepreneurs, when you start up, the first thing you ask yourself is, do you need money? If you really need money, right, you have to be very prepared in 6 months to fold up. Because there is a very high chance you might get a little bit of angel money, parents, friends, family, all that's good. But if you need some serious money running into the millions of dollars, right, you better have a plan B. Because my sense is that 1 out of 1,000 companies which get started go beyond the angel stage, right? So strong encouragement, bad for the VC industry. Please don't tweet telling people that Niren Shah said, don't raise money. But I still believe that do it without money. Ask yourself. Let's assume you do raise money, right? Commit full time to this. If you're a 4-member team, one guy is going to keep pitching for the next 5 months. India is very unique. We have 5 geographies of where lots of venture is happening. So you'll be going all over the place pitching. It is a full-time job, at least for those 6 months. So one of the things we've seen at Norwest is whenever a company is raising funds, right, you're in that point, next round, round after round happens, we find that the financial performance of the company in those 3-4 months definitely dips. There is a very strong correlation where a 50-year-old fund, we do run a lot of data, there is a very strong correlation between companies not meeting plan and being on the road for funding. And the reason is very simple. A startup is constrained for resources. It does not have too many people. The CEO, CFO, co-founder are all busy on the fundraising. The business is kind of running a little bit on its own and the business drops. But however, I've also seen the converse to be worse. They want to raise funds, but they're so busy with the business, they don't want to commit to raising and the funds just never get raised. So it's one of those things, our advice has been very clear. If you want to raise funds, right, make sure that you're pitching well, right, and that you are able to actually go out and spend that time and effort on a full-time basis, right, to raise those funds. Because otherwise, we've experienced it in some of our companies as well. Otherwise, it's very, very hard. Now, in pitching, I will just give you this one thing. There's a great guy called Kawasaki, who has this 10-20-30 rule, which I love. Remember that a VC, another side, he's hearing pitches 4-5 times a day, right? So you have to treat them like a third standard child, right? If you give him 2.5 hours of detail-oriented stuff, they're not going to be interested. So this rule called the 10-20-30 rule, I find to be very interesting. Basically, you need to have 10 slides. And trust me, we have a global fund, we do global pitches. Our India group comes out with pitches with the longest number of slides. Because all of us, I think it's a bit cultural, we believe passionately in what we do. And passion is translated through a 100-page pitch deck, right? Which almost kills the other side. 10 slides, no more than 10 slides, right? If you can't distill it down to 10 slides, please remember that something is wrong. 20 minutes, you will probably get 45 minutes to an hour. But there needs to be a lot of question time. People want to drill into certain parts of your business. 20 minutes, right? And 30-point font, which I have used before anyone asks me. So in PowerPoint, you get the font size, 30 font. Because the other thing is people write, I told someone of this 10, 20, 30, one of my companies, they came back in 10 slides, right? It still took 1.5 hours. And the reason was they basically wrote a PhD in 10 font in those 10 slides, right? And that doesn't work. Really, it doesn't work. So remember, just have empathy for the other side, right? When your father or mother, when you were young, were giving you what they believed to be the most important lecture in their life, right? How much attention did you pay? Right? And at that point of time, I would still say that this is a full-time job, but do your pitch well. A lot of companies get tainted when their first pitch is all over the place. The second time, these people, various funds, angels, seed funds, VCs, PEs, whatever, they don't create time for that second pitch, right? They are judging not only your pitch, they're judging you. They're judging the quality, the 5 C's, I love that, which Sandeep said, your capability, your capacity, your ability to be able to build a really, really large company. So keep that in mind. So anyone invest in the stock market here? Okay, few guys, thank God for you, very few guys. So anyone has timed the market perfectly? Right? So my answer is a simple 4-letter word here, right? Don't. I don't know what you were thinking. Anyway, it's don't, right? Don't try to time the market when you have a startup, right? I have a great example. We have a company called Pepperfry. We funded it right up front. And one of the great things about Amrish is that Amrish decides when he needs the money and he goes out and gets it, right? Most of the times we've gone out to get money with Pepperfry, we've done 3-4 rounds, the market is actually bad. And remember, there are only 2 states of the market. The market is either bad or the market is okay. I've never seen an entrepreneur come and say, the market is great, let me go and do something right now. Because the greatness always is going to come, right? 6 months later, the market is going to be even better. So we've typically gone, and and I tell him that, listen, if we wait a few months, maybe we'll get much better valuation, we're not getting value, and his view is clear. Niren, little bit up and down, doesn't matter. Right? Let's just go out, raise the funds we need, and focus on the business. So don't time the market. Very simple. The market now, people have asked me and are going to ask me, market is bad, right? We have, in fact, for the last 15 months, we have really moderated our new investments. We obviously continue to support this. And we are actually just about getting aggressive. So you'll see us do a lot more than what we've done last year or year before. But I would say, on the whole, globally in US, China, India, the whole e-com internet market currently is definitely going through a moderation and probably will go through a deeper correction in the next 6 months. When you go to a VC and you ask for money, well, my view is it's not all about money, right? In some ways, I look at this as a really I don't know if you're aware, but the average US funded company takes about 7.1 years to exit. I think in India, it's probably 9 years, right? We've been in companies for 8-9 years already. So remember one thing that, and I think Sandeep alluded to this, that when you actually are going and choosing a fund, and I believe it's a two-way choice, right? Remember that you are entering into some sort of a marriage. I think average marriages also nowadays last about 9-10 years. So you are, no, I'm just joking. Okay. So my 2 cents is that a VC brings a lot to the table, right? For instance, in Norwest, where a lot of us are all entrepreneurs or ex-entrepreneurs, we spend a boatload of, let's say, for me in the afternoon, I made it discipline saying spend time with the, helping your companies, whether it's a introduction for Swiggy somewhere, whether it's something else for Pepperfry, whatever it be the case. I think VC or the guy on your board, whether he's a seed fund, VC, whatever, he's like a free resource. He's been through a lot. He's seeing a lot in the market. He's meeting 3-4 companies a day. You want much more than the money. Right? In fact, that is really my learning when I was at Bazi, that the board members, the good board members, they're adding a lot more of outside-in perspective. They're able to actually sell better to the potential CFO you want to hire or the head of HR you want to hire, right? They're able to give you advice which your ears at that point of time may not have. And the most important thing in something like this is that they have to be able to spend time and they need to be patient, like every marriage. I'm not going to spend too much time. If you can, build a consortium. If you think you need a lot of money, what's required is that multiple, like if you have, let's say you need $5 million, everyone historically would say, I want one guy because there'll be only one guy on my board. We always say, get two guys, because when money runs out, it's much easier, guys, for two guys to pony in a little more money to keep you going, right, till the market improves or till your sort of numbers improve. So getting a consortium is very important. Of course, don't take that to the other extreme. Having 6 people on your board is unmanageable, but having 2-3 people, I would say, is very helpful. So how much do you raise, right? I mean, a lot of people have told me that, listen, I have this good company, I have a lot of people on the door waiting, how much do I raise, right? My view is that, firstly, you don't want to raise too much. I know it doesn't sound like great advice, but I can candidly tell you that every single company which has raised huge amounts of money and they're lying in the bank account, every now and then the founder looks like this, right? And he's got a bit of pressure there. He's looking there and he's saying, this pile of money is lying there. I've taken it from these investors. I took $100 million. I have to grow faster. And then what happens is the marginal utility at which you're spending, the marginal cost of spending starts going way high. And you're sort of not in line with the product market. You're not in line with the sort of cost and revenue. So my sense is that you want to raise enough to be able to show substantial traction, maybe 2x your revenue, maybe 3x your revenue, right? But you should also be open, regardless of market conditions, to come back to the market at, let's say, in 18 months, because your valuation will be higher, your dilution will be lower. We'll talk about that, right? And at that point of time, there'll be more validation. So don't go all out. Obviously, I always also say that, raise 20% more than you should. Doesn't mean you go out and try to raise $100 million just because you can. If you need 30, maybe you raise 35, because companies tend to be off plan. But still, you have to moderate that, right? Now, there are some norms, and a lot of people find it very surprising. I find it very surprising. A lot of people don't know. If you're doing a seed deal, you're brand new, you just started, product market fit is not yet known, you're sort of getting your team together, etc. Seed deal, first money in. Typically, people get about 50 lakhs, I would say up to 5 crores, right? And dilution can be anything between 10% to 30, 40%. There's no, again, like I said, it's becoming a science, but it's still an art. If you're doing a Series A deal, I typically find in the Indian market $2 to $5 million, what typical Series A's, right, are at. So you raise $2 to $5 million, again, you're giving up anything between 20 to 35%, right? A lot depends on whether it's a fully formed Series A or not. Series A means the first round, first institutional round. Series B is about 7 to 15 million. Series C is very wide, can be 15, 20 million all the way up to like 50 million, 100 million as well, and then it goes on depending on the company. But there are some norms, like, if you came and walk in and brand new company and said, no, I want $20 million, not going to happen, right? So unless it's something very, very outside the bell curves. Valuation and dilution, frankly, as a VC, and I'm talking on my side yet, I've never found that valuation has mattered. If a company does well, you always make enough money. If the company did badly, you should never funded it. The valuation didn't matter. So for us, a lot of our companies, we realized that we were very pained about that valuation. We thought we were, getting, 50% higher, and we were absolutely outraged. And then one round later, it looked like a very cheap valuation, right? And there have been companies, at least one of them, where we felt we got a great valuation deal, but the company is probably not going to be around. So it didn't matter. So I would say from an entrepreneur standpoint as well, try to do what's fair. We have actually convinced one of our entrepreneurs in a subsequent round that somebody was coming on a big horse and giving him a valuation which was much further away from what we deserved, right? We were already insiders. We had done the first round. The second round person was coming and putting in a crazy valuation. Now, what you don't realize today, and this is sort of what I've seen in the US and India, is that when you take a really large valuation as an entrepreneur, you take pressure, right? You have to deliver to that valuation. And when you can't deliver it and the next round is a down round, it creates and wreaks havoc in your company, because all the options are sort of now underwater, you're demoralized, you are still a founder, you have the passion, but employees below you are demoralized. That new investor who came in is now looking bad in front of his committees, etc. So remember that when you actually sort of give valuation, we have been very prudent. Like when we've come in early and they're new investors, we always wanted to be fair, plus minus you can argue 20%. But when something goes completely out of whack as an entrepreneur, right, you are taking that on your head. You will be working, anyway you're working 24/7, now you will be working whatever, much longer than that if that's physically possible. So don't worry too much. Again, also remember that chart out your company, right? Like one of the things I tell some people is, I've been telling people is, let's say you want to do this, right? You want to build a company and you think just on Excel, what will your first round be? What will your second round be? What will your third round be? Right? It's very hard. It's very pie in the sky. But what will they be? You put it on Excel, see your dilution. Suddenly one guy wanted to do something on the gold side, came and told me that, listen, I'm ending up only with 2% in the end. So I said, look, the numbers are all fuzzy. They're not going to end up there. But at least you know your floor and your cap. If you're ending up at 2%, something is wrong with the fundamental way you're thinking because you're raising too much money, you're not creating too much value, and you're not going to do this for 2%, hopefully. Right? But at the end of the day, that's only like a broad way of saying that how much should you raise, how much should you dilute. You shouldn't end up at sort of the fifth round and suddenly realize, hey, I have nothing left. Why am I doing this, right? I think planning a little bit, although it never always goes per plan, but just a little helpful. Check the fine print. I would say that a lot of entrepreneurs, they look at the legal docs and they don't even hire lawyers. And they'll just say, and we take it upon ourselves to have to go through one line because we don't want any misunderstandings later. But VC docs have some pretty kooky stuff, right? It's, there are terms called participation, there's liquidation preference, there's lots of stuff which VCs have used over the years, and it's a 50-year-old industry, to protect them. For instance, a liquidation preference is one where, you're almost getting your money back, right, if the company sold for less than the amount of money put in. So what the VC is doing is that at the downside, supposing the VC is putting $20 million and that's all there is, at the downside, if the company got sold for 18 million, all the money will go to the VC, right? And the reason is that they are saying that, listen, on a downside case, we're treating it a little bit like debt. Now, this is a very standard term across all VC deals, across US, China, India, wherever, Brazil, Israel, etc. Right? It's just very important you understand them. If you don't understand terms like these, later there will be, I was at Bazi and we didn't understand this lick pref. Honestly, we didn't. So when we finally looked at it, we said, what? And at that point of time, it was really, we were 26 years old. We just used to take the docs and then we used to file them very nicely. So we'd punch the holes and all that and put them in the file. And then we didn't realize after that the filing was not that material. We should have actually been reading them properly. The things we didn't understand in there and there are much more abhorring terms as well in some of these documents. So it's very, very important. You may not be a legal guy, you may not be a product guy, but if you want to raise funds, you got to read the docs. If you don't read the docs, don't raise the funds. Right? Very important because later it causes, and again, I would say a lot of good VCs, they run you through it painstakingly, saying, hey, this is the terrible term which you will find a little crazy. Here's why it's there. Here's what it means. This is what happens to you in the downside case. Are you absolutely sure you still want to do it? Right? That is a sign of a good VC. So going on with that marriage thing, right? Choosing a firm is like kind of choosing a family, but choosing the guy on the board is like choosing your spouse. That person is going to sit. Then you need to have genuine chemistry, a bit like your spouse, right? You need to understand that person very well. You should know that at 10 o'clock at night, he will take your calls. You should know that if you have a regulatory issue and something goes wrong in your company, he's got the contacts, he's backing you up. And over and above, you should also feel good about being able to go and have a drink or with him or her, right? And being able to just discuss things, because a VC goes through lots, an entrepreneurial venture goes through ups and downs, right? Lots of times it goes through big downs as well. And people on your board, right? We had two types of guys on my Bazi board. There was one guy who would fly in from Hong Kong every board meeting and spend extra time with us, helping us on some, very basic problems In Bazi, our boardroom discussions used to be, is internet, Bazi was 2000, 2001, right? Probably the only exited company. Our boardroom discussions would be, are there 1 million consumers or 1.25 million? Right? That was the whole, like we would have huge debates about, we're just talking about 200 or 200 million consumers. There was another guy, very interestingly, and we were not meeting our plans because the internet didn't take off the way it was. We were still building a good company. We got a good exit, but we weren't meeting our plans. And he looked at me, and I was the CFO, looked at me and said, listen, look into my eyes. I was 26 years old. Look into my eyes and tell me, I will meet the plan. So I said, okay, I'll look into your eyes. And I looked into his eyes and said, I will meet the plan. He said, okay, let's now go meet the plan. Right? And so I went marching thinking that now I've been hypnotized or whatever, I will meet the plan. Nothing happened, right? We didn't meet the plan again. On the other hand, the other board member was sitting with us and saying, okay, these are the 6 problems, right? We're rowing in a river furiously, but there's no water. So what else can we do? We built a payments business, we built a B2B reverse auction business, and we did get a good exit on the back of a few other things. So I think it's this critical, right? We want good positive karma on your board. You want good people, and I think it's very critical. I have felt it firsthand, and I see it on other boards as well. There's one, if you've got 4 board members and one of them is a little bit, table thumping, screaming, shouting, it's just painful. And lastly, funding is a little bit like crack, right? Don't get hooked onto it. I mean, we see a lot of guys are, they take funding, they become bull market CEOs, they can grow like a rocket ship, but remember the party does end. Right? You have to eventually build a great business. A business means profit, cash flow, right? You can't get hooked to your funding. So they can do round after round, they're good, they present well, they do everything nicely, but at the end of the day, 6 years later, the company is still burning like crazy, right? You don't really have a business, and you look back and say, what have I done, right? So most importantly, don't be a bull market CEO. Be willing to sort of take it in your chin up and down times, and don't get hooked to the funding. You should at some point be understanding that the funding is a little bit like of, let's call it legal steroids, for you to do a couple of runs to feel how good it feels and to build something in the process. After that time, you have to be, like VCs and Ps fund these companies because we want them to be billion-dollar companies in 5, 6, 7, 8 years, right? It's hard to do. Without funding, it'll take you 15, 20 years. It's hard. So you're getting a boost. The boost is not there forever, right? Even if markets have gone crazy, they will moderate, they will correct. So it's very important, right? So I'm hoping that, this sort of helps. A lot of people have asked, and I did spend a few hours last night. It was late though. So I hope this helps. And I'll sort of try to end and open it up to questions by saying, congratulations if you raise a round. But after all this, the journey has just really begun. So wish you all the best. Questions?
Yeah, hi, this is Adnan. I want to understand, how do you arrive at a fair valuation for a startup?
Yeah, so this one is really an art. There is zero science to it. There are certain norms. Most people, when you talk to, they will say that, listen, Series A's, like I mentioned, normally seed rounds happen at A to B range. Let's say it's, starts at 50 lakhs to a couple of crores. And then there are certain percentages which happen basically through demand and supply, right? What, again, good VCs try to do is, if you really get a one-sided deal, what happens is, let's say you put in 2 crores and got 40% of the company, which I think is a pretty one-sided deal towards the VC side or the seed fund side. 1 or 1.5 rounds later, nothing much is left for the entrepreneur. And we have to remember, and we do remember, that we are not the entrepreneurs. The entrepreneur will leave and we will be running the company. That's not our core competence. We are partners. So at the end of the day, we have to do what's fair, but it should also work for the other guy. And today you see a huge number of people quitting some of the big, unicorns, etc., because they've all vested. They've come down to a small stake. They don't feel like, very, very senior founders or founding team any longer, and they leave. So I think the answer to your question is, there are certain ranges, which I mentioned, for dilution. At the same time, I think there is a huge amount of demand supply. If you got 5 guys, those ranges definitely get broken down. 5 guys chasing you. If you have no one, it might happen the other way. You might say, listen, I need that crore, I'm going to give up 25%, although I would have preferred to give up half of that. So there's no real science there, but at the same time, there are some sort of, general ranges which you can use. I again feel any good funder realizes that he's not running the company. So instead of making a problem for later, and also I think that this is a human business. So a lot of people ask me, what if this, what if that? Remember, we believe that the entrepreneur is firmly in control. Tomorrow the entrepreneur comes back to us and says, listen, I'm really not motivated to do this. It's a really big problem for us. So all along, it's very important to be fair to the other side, because otherwise, even if you're unfair, if you were unfair for some time, you got a great deal, that great deal is not going to last, because this is a 9-year relationship. Right? Sooner or later, you're going to be discovered that you were cheating, right? So I think this is one of those things where you should really get to know your sort of funder / board member. And at some point of time, we have sat somewhere and someone has just looked at me and said, Niren, it would really mean a lot to me if I could sort of bring you down to 25% instead of 30%. And we just looked there and said, okay, now how do I explain how valuations work, right?
Thank you.
Welcome.
Good afternoon. Hi, I'm Gaurav Joshi.
Nice to
Small question like,
Sure.
what do you think about the hyper-local delivery business, because you're invested in one of them called as Swiggy?
Yeah.
And it's going around like burning cash out all over there.
Yeah. So it's interesting. I think that like a lot of businesses, right? Hyperlocal for us, we still think that hyperlocal is a good business model. It's just a tough business model, right? So what happens is that every time, and for everyone in the audience, hyperlocal is basically when you're delivering locally, right? So Swiggy is a company in the food delivery space. It's, when we funded it was number 4, now it's number 1. Basically what happens is that you'll order using your app, and they will have delivery boys, and you can track those delivery boys where they are exactly, and they will deliver to your home office, whatever. The challenge in all the hyperlocal models globally, China, India, US, has been that it takes a lot of money to make that delivery, right? So it's a 300 rupee order, but it normally costs 60, 70 rupees to deliver, right? And therefore, how do you make money? Because the restaurant is almost giving you that much money, right? So I think what happens in these things is certain models are harder. I find payment companies also harder. You make very little interchange. But as long as you can execute, right, and you can sort of densify the deliveries, you do multiple deliveries per hour, right, you can charge a better margin, you can take your AOVs higher, the model actually does work. So what we are seeing is that at scale in certain cities, we're already sort of breaking even in certain neighborhoods, right? And so as long as we are very clear that just growth doesn't work, the unit economics has to work. My view is that you will find that the men get separated from the boys in the hyperlocal space. It's not an easy space, but it can be cracked for India. And it's not, just to answer your burning part, burn has been constant and the company has probably grown 3-4x in the last 5 months.
I have one more question, Rupal
Sure.
Panchalia. In the space of IoT and big data, what I see is that unless there's
In the space of which one?
IoT and big data,
Okay.
unless there's a revolution which happens in the IoT space, especially I'm talking about India, the analytics in big data would not come in place. But that is something which is on the horizon in the next few years. Now, in such case where a company is, say, has a proof of concept, and it can't actually go and demonstrate the whole cake, but it can say, yeah, we can show you the icing on it. In that case, what would be a valuation like?
Yeah, look, it's hard to understand. See, a lot of the valuation is, based on what people think this can become, right? There are many ingredients into something like this, right? So it's going to be what has been proven so far, the risk, what will it become, reward, and potentially some demand supply and negotiation thrown in the middle somewhere, right? So it's very hard in my mind to give you a concrete answer. I would say this though, that IoT seems to have taken off a lot. It's a big category, we think. It's taken off a lot more in the global markets. I think it will come to India. The question, of course, is that do the global devices, I mean, I'm using an Apple Watch or whatever, do they come to India? Can we have some homegrown devices? We've seen some guys like Goki and others sort of ramp up, in some ways. So my sense is it'll do well in India, but it has to have some differentiation at a local level. And then if you're right at the bottom where you're starting your proof of concept, then I would again suggest that you'd go to the angels, take a couple of crores, prove it out, go to the next level, and then sort of build from there. Eventually, even IoT needs to scale as a business, right?
Yeah, thank you.
Hi, my name is Abhishek. I had a question with Swiggy. You said it was the fourth when you invested in the same category. What is it that you looked at, because there were three already in the market, and this could go for any other sector? So
that's a great question. Yeah. So basically what we're really looking at is, in some ways it's a storm in a bottle, right? We want to really look for all the ingredients. We feel food delivery is a massive space, right? There are a couple of multi-billion-dollar companies already created in China. There's a Meituan Dianpeng, which is merged. Part of it is food delivery. We also think that there are a couple of, LMEs, a $4 or $5 billion company in China. These guys are doing 2 million orders a day, right? So there's going to be massive companies. I think it's as big a space like the horizontals. We were looking to do something in that space. Now, again, our thesis was that it's very hard. Like when people, I have this little joke that when people are hungry and the food doesn't come, they get angry, I mean, it's just like when you're hungry, you just want the food. It doesn't matter how smart you are, how rich you are, how whatever, you just want the food. So what Swiggy does is you can track that guy on the scooter, right? It's currently doing massive number of orders across India, and it's able to also scale locations. So it started in Bangalore, Hyderabad, it's now moving into Mumbai and everywhere else. So there are a lot of tech which is involved in making sure the pickup, drop-off, problems, etc. is done. So we saw the team primarily, right? In all of this, the team is critical. The vision of the team, as Sandeep put it last meet this. And then we also saw that they have built out the tech and they're starting to hit J-curves in all the cities. So, you're starting to kind of get that J-curve, despite some of the competitors spending a lot of money, right? I just read an article where it said a lot of people were making moats, but out of paper. In a fort, you have a moat, right? Where it prevents others from attacking you because it's got crocodiles. But moats are out of paper, and paper being money, right? So those we felt that it doesn't matter. This team is very tiny. The number of orders is very tiny. Right? But it doesn't matter because it's a great team. They've got the idea, they've got the model, and they're growing rapidly. And the market is, the customers, the restaurants think very highly. So for us, we've never had a problem building a contrarian bet. As long as we feel very strong about our judgment on those things. And obviously, at the end of the day, all of these are bets, and we'll see what pans out. But I don't know if I answered your question.